There's a fundamental pattern in economic history that repeats with mechanical precision. It doesn't appear randomly, but only when a set of specific, toxic conditions perfectly align. Those conditions are extreme asset valuations, record-breaking debt levels, excessive leverage across sectors, a widespread belief that this time is different, and finally, a trigger event that violently forces systemic liquidation. These exact conditions existed in 1929, they existed again in 2008, and right now, in 2025, every single one of these conditions exists again. Not similar conditions, identical conditions. The stage is fully set. The key players are positioned, and if history serves as any guide, the resulting systemic crash will unfold in late 2026 or early 2027. This is not prophecy. This is not baseless doom-mongering. This is pure pattern recognition. Let me show you precisely how these crashes violently unfold. Who ultimately loses everything, who profits enormously from the chaos. And critically, why the 2026 to 2027 crash could be worse than 1929 and 2008 combined. Because the scale of the leverage is exponentially higher, the global interconnection is profoundly deeper, and the institutions in power have already expended all their conventional ammunition fighting the last crisis, leaving absolutely nothing in reserve for the next one. What I am about to reveal is a forensic documentary analysis of a crash that hasn't happened yet, but one that follows a pattern that has occurred twice before with terrifying, devastating accuracy. The core mechanisms are the same. The overall timeline is highly predictable, and the outcomes, who gets destroyed and who gets rich, follow the same script every single time. Let me start by showing you where we are right now. January 2025, the setup. Every major crash begins with a bubble. And we are currently sitting inside the largest everything bubble in recorded history. But this valuation distortion extends far beyond just the stock market. Real estate in major metropolitan cities is at all-time, unattainable highs. Now, let me show you how this dangerous setup compares to 1929 and 2008, because the patterns are horrifyingly identical. In 1929, the stock market had aggressively surged for 100% from 1924 to 1929, a massive 5-year boom. Margin debt borrowing to buy stocks reached 10% of GDP. Everyone was leveraged. Everyone believed that stocks only go up. The fatal phrase permanently high plateau was used by leading economists in 1929 to describe the new era where market crashes were supposedly impossible. Then October arrived. The market catastrophically fell 89% over 3 years. In 2008, the housing market had doubled from 2000 to 2006. Mortgage debt reached 100% of GDP. Everyone was leveraged, buying houses using highly toxic subprime loans. Everyone believed that housing prices never fall nationally. Then the subprime mortgages began mass defaulting. The financial system suffered a catastrophic collapse. The S&P fell 57%. In both historical cases, the setup was the same: asset bubble, excessive leverage, widespread belief in permanence, followed by a trigger, and then inevitable cascading liquidation. The 2026 crash will follow the same blueprint. We have the everything bubble, we have the unprecedented leverage, and we have the universal belief that Fed intervention makes crash impossible. All that is missing now is the trigger, and there are multiple candidates already lined up. Let me show you the 3 most probable triggers and how each one could instantly start the cascade. Trigger 1. Commercial real estate CRE collapse. This is the most likely initial trigger because it is already underway. Office buildings across America are facing 40 to 50% permanent vacancy due to the structural shift to remote work. Companies that previously leased 5 floors now lease 2. This is permanent. Remote work is not reverting to 2019 levels. Crucially, these colossal buildings were financed with mortgages at ultra-low 3% interest rates. Those mortgages are maturing right now and must be refinanced at crushing 7% to 8% rates. A building that barely generated enough rental income to cover debt service at 3% is automatically bankrupt at 7%. The math is unequivocally broken. Building owners are simply walking away. Brookfield Asset Management, one of the largest global real estate owners, defaulted onto Los Angeles office towers in 2023. They simply stopped paying and gave the buildings back to the lender. This wasn't due to Brookfield being in trouble. It was because those specific buildings were already worth less than the mortgages they carried. It is economically rational to default. Over $2 trillion in commercial mortgages mature between 2025 and 2027. If just 30% default, that translates to $600 billion in immediate losses. Who holds these toxic mortgages? Regional banks. Regional banks have massive, concentrated exposure to commercial real estate. Community and regional lenders hold 20% to 40% of their entire loan books in CRE. When those loans begin mass defaulting, banks must recognize enormous losses. Those losses instantly eat through bank capital. When capital falls below regulatory minimums, regulators close the bank. We've already seen the initial tremors. Silicon Valley Bank collapsed in March 2023. Signature Bank failed the same week. First Republic failed in May 2023. While these failures were officially blamed on interest rate risk, the underlying systemic issue is the impending CRE crisis. If CRE defaults cascade violently through 2025 and 2026, we could realistically see 50 to 100 regional bank failures. And mass bank failures instantly trigger global panic. Trigger 2. A major corporate bankruptcy or sovereign debt default. Hundreds of corporations issued massive amounts of low-interest debt during the 2020 to 2021 period. That debt is maturing now. They must refinance at rates that are double or triple what they previously paid. Many cannot afford it. If a major corporation, a Fortune 500 company, defaults on its bonds, it instantly triggers contagion. Bond investors panic. They aggressively sell other corporate bonds. Yields spike uncontrollably. Borrowing becomes impossible for all firms. Companies that desperately need to refinance cannot. More defaults inevitably follow. This is precisely how the 2008 crisis spread. Lehman Brothers failed. Then everyone assumed other banks would fail. Credit markets instantly froze. The same freeze could happen now with corporate debt. Sovereign debt default is similar, but exponentially larger. If a major emerging market, Turkey, Argentina, Pakistan, defaults on its dollar-denominated debt, it instantly triggers profound questions about other vulnerable countries. Can they pay? Investors sell all emerging market bonds. Capital flees instantly, currencies collapse. More defaults inevitably follow. This creates a global credit crisis. Emerging markets hold trillions in dollar debt. If they cannot repay, the European and American banks that lent to them take massive losses. The contagion spreads from emerging markets back to developed markets. One default ignites the cascade. This is the external, black swan event, a major war, a new pandemic, a coordinated terrorist attack, or a violent election crisis. Anything that instantly spikes volatility and forces investors to suddenly sell assets to raise cash. The COVID crash in March 2020 was this type of trigger. The pandemic was not initially an economic problem, it was a health crisis. But the sheer uncertainty forced massive liquidation. When you genuinely don't know what is coming next, you sell everything you own and flee to cash. If another shock of similar magnitude occurs, a full-scale war with China over Taiwan, a conflict in the Middle East severely disrupting global oil supplies, or a violently contested U.S. election, any of these could trigger the exact same flight to safety that causes systemic liquidation. Any of these three triggers could start the cascade, but the root cause is always the same: excessive valuations and maximum leverage. The identity of the trigger ultimately doesn't matter much. Once liquidation starts, the mechanics of the crash take over. And those mechanics are brutal, predictable, and devastatingly efficient. Let me walk through exactly what happens once the crash begins. The timeline may be compressed or extended depending on the speed of liquidation, but the sequence is always, undeniably the same. Phase 1, the initial shock. The trigger event occurs. Markets instantly fall 10% to 15% in days. Investors are shocked but not yet fully panicked. This is widely viewed as a buying opportunity. By the dip, media outlets interview analysts who loudly claim fundamentals are strong and this is temporary. In 1929, the initial shock was October 24th, Black Thursday. The market fell 11% in a single day. Panic, but not catastrophe. Bankers met and pledged to support the market. Stocks recovered slightly. Everyone believed the worst had passed. In 2008, the initial shock was March 2008 when Bear Stearns collapsed. The market fell 15%. The Fed arranged a bailout. J.P. Morgan bought Bear Stearns. Crisis averted, or so everyone deceptively thought. In 2026, the initial shock will likely be a major bank failure or a wave of corporate defaults. Markets fall 10% to 15%. The Fed issues a statement. We are monitoring the situation. Investors buy the dip. Stocks recover partially. But the damage is done. The crack in confidence has appeared. Phase 2. The false recovery. After the initial shock, markets briefly stabilize or even violently rise. This lasts for weeks or months. It is the most dangerous phase because it convinces the majority of people that the worst is over. In 1929, after Black Thursday, the market recovered for a week. Investors who sold felt foolish. Those who bought the dip felt vindicated. Then November 11th arrived. The market fell 13% in a single day. The real crash had begun. In 2008, after Bear Stearns collapsed in March, markets stabilized through the spring and summer. By July 2008, the S&P was only down 10% from its October 2007 peak. Many analysts officially called the bottom. The financial crisis is contained. Housing has stabilized. Then September arrived. Lehman Brothers failed. The market fell 40% in 6 weeks. In 2026, the false recovery could last 3 to 6 months. The initial bank failure or corporate default is blamed on specific mismanagement. It is isolated. It doesn't reflect the broader economy. The Fed cuts rates modestly. Markets rally. Investors believe the crash is over. But beneath the surface, the systemic problems are relentlessly spreading. Phase 3, the cascade. This is when the real crash happens. Forced liquidation, margin calls, panic selling. In 1929, the cascade lasted from November 1929 to July 1932. The market fell 89%. In 2008, the cascade was much faster, September 2008 to March 2009, a 57% fall in 6 months. The 2026 cascade could last somewhere between 12 to 18 months, a devastating 50% to 70% decline from peak to trough. Here is how the cascade works mechanically. Stage 1 of the cascade, margin calls. Leveraged investors are forced to sell when stocks fall. They borrowed on, say, 50% margin. If stocks fall 20%, their equity is wiped out. The broker issues a margin call, sell now, or we will sell for you. These forced sales drive prices lower. Stage 2, institutional redemptions. Mutual funds, hedge funds, pension funds, when their asset values fall, their investors demand their money back. The funds must sell stocks to raise cash, more selling pressure. Stage 3, algorithmic amplification. High-frequency trading algorithms see prices falling and instantly accelerate the selling. Stop-loss orders trigger. Circuit breakers temporarily halt trading, which only creates more panic when trading resumes. Stage 4, liquidity disappears. When everyone is selling and almost no one is buying, there are no bids. Stocks gap down 10%, 20%, 30% because there is no beer at any reasonable price. The market isn't declining, it's collapsing. Stage 5, credit markets freeze. When stock prices are plummeting and panic is widespread, banks instantly stop lending. Why risk lending money when the borrower might go bankrupt tomorrow? Credit freezes completely. Companies that desperately need to refinance debt cannot. They default. Banks that lent to those companies take massive losses. The cycle accelerates violently. During the cascade, the entire economy enters a severe recession. Stock market crash destroy wealth, potentially $30 trillion in market value could be lost. Consumers feel poor. They slash spending. Companies lose revenue. They lay off workers. Unemployment rises from 4% to 9% or 10%. Laid off workers cut spending further. More companies lose revenue. More layoffs. This is the feedback loop that transforms a simple market crash into an economic depression. Phase 4, maximum panic, the bottom. This is the ultimate bottom, when fear is so extreme that people sell absolutely everything, regardless of the price. In 1929, the panic bottom was July 1932. The Dow hit 41, down 89%. Unemployment was 25%. Banks were failing by the hundreds. In 2008, the panic bottom was March 2009. The S&P hit 666, down 57%. Unemployment was 10%. Major banks were insolvent and required government bailouts. In 2026, the panic bottom could come in late 2027 or early 2028. The S&P, currently at 6,000, could fall to 2,000 or lower. Unemployment hits 10%. multiple bank failures, massive government intervention. This is the moment of maximum fear and maximum opportunity. Phase 5, the slow recovery. This stage begins when the government and central bank intervene massively. In 1933, Roosevelt launched the New Deal, creating jobs, reforming banking, and restoring confidence. The recovery from 1929 took a decade. Stocks didn't reach 1929 levels again until 1954, 25 years later. In 2008, the government bailed out banks. The Fed printed $3 trillion. Congress passed stimulus. The recovery was faster. Stocks reached new highs by 2013, 4 years later. The full economic recovery took until 2015. In 2026, 2027, the government will intervene again, but the scale will be larger. The Fed will cut rates back to zero. Congress will pass multi-trillion-dollar stimulus packages. Banks will be bailed out. But the recovery could be slower than 2008 because the current debt levels are monumentally higher. Government debt at 120% of GDP. Adding trillions in stimulus pushes it to 150% or 180%. At those crippling levels, debt service consumes most tax revenue. The government faces impossible choices: austerity, raising taxes, or inflating away the debt. None are easy. The recovery could take 5 to 10 years. Stocks might not reach 2025 levels again until 2032 or later. This is the 5-phase pattern: initial shock, false recovery, cascade, panic bottom, slow recovery. Now, let me show you who gets destroyed and who gets rich. Every crash creates a massive wealth transfer from those who do and see it coming to those who meticulously position for it. Who gets destroyed? The middle class holding stocks and homes. In 1929, the middle class that had poured savings into stocks lost everything. Families that felt wealthy in 1928 were destitute by 1933. Their stock portfolios fell 89%. Their homes were foreclosed when they couldn't make payments. In 2008, middle-class homeowners who bought at the peak lost 40% to 50% of home equity. Many went underwater, owing more on the mortgage than the home was worth. In 2026, the same story plays out. Middle-class families with 401k retirement accounts will watch them fall 50% to 70%. Now, who profits? This is the critical blueprint. Every crash makes someone new very rich. In 1929, Joseph Kennedy made $50 million, hundreds of millions today by shorting stocks. Bernard Baruch held cash and gold, bought assets at depression prices, and emerged wealthier than before the crash. In 2008, John Paulson made $20 billion betting against subprime mortgages. Michael Burry made $700 million. Warren Buffett made billions buying Goldman Sachs and Bank of America crisis prices. In 2026, the same playbook will create the next generation of billionaires. Who profits? Cash holders. The investors who sold stocks before the crash and held cash or treasury bills. When stocks fall 60%, cash doesn't fall, it gains purchasing power. You preserve capital while everyone else loses half. Then, at the bottom, when everyone else is paralyzed by panic, you deploy that cash. You buy stocks at 40 cents on the dollar. You buy foreclosed real estate at 50% of peak value. You buy businesses being liquidated. Warren Buffett held $325 billion in cash in 2024. When the crash comes, he deploys it. He makes the same investments he made in 2008, but on a larger scale. Short sellers profit. Investors who bet against overvalued stocks or sectors. In 2026, the obvious short targets are commercial real estate, regional banks, and over-leveraged corporations. If you short a bank stock at $50 and it falls to $5, you make $45 per share. Hedge funds building these positions now will make billions. The exact trade Paulson and Burry made in 2008. Gold holders profit. In 1929, gold was fixed at $20 per ounce. Then in 1934, Roosevelt revalued it to $35, a 69% gain for gold holders. In 2008, gold went from $800 to $1,900 by 2011, a 137% gain. In 2026, gold could go from $2,700 to $5,000 or higher. Why? Because when the crash comes, the Fed prints money, massive stimulus that instantly devalues the dollar. Gold, which cannot be printed, appreciates. Distressed debt buyers profit. When companies go bankrupt, their debt trades at 10 to 30 cents on the dollar. Vulture funds buy this debt, wait for restructuring, and collect 50 to 100 cents. A $100 million investment becomes $300 million. Carl Icahn, Howard Marks, Oaktree Capital, they all made fortunes buying distressed debt in 2008. They'll do it again. Real estate investors with cash profit. When foreclosures spike, properties sell at auction for 40% to 60% of value. Investors with cash buy entire portfolios. They rent them out, wait for the market to recover, and sell for huge profits. Blackstone did this from 2009 to 2012. Private equity firms profit. They have raised trillions in dry powder, capital waiting to be deployed. When the crash comes, they buy liquidated companies and corporate divisions at 30 to 50 cents on the dollar. They hold for 5 years during the recovery and sell at full price. This creates generational wealth. The firms that see the crash coming and position before it happens create dynasties. This is the predictable wealth transfer from the middle class holding stocks and homes through the crash to the elite investors who sold before, shorted during, and bought at the bottom. It's not illegal, it's understanding the cycle. Crashes don't destroy wealth, they transfer it. Let me compare the 2026 crash to 1929 and 2008 directly. What's the same? The bubble mechanics. All three started with asset prices fatally disconnected from fundamentals. 1929 stocks at 30x earnings, 2008 homes at 5x incomes, 2026 everything at record valuations simultaneously. The leverage is the same. Margin debt in 1929, subprime mortgages in 2008, corporate debt, consumer debt, government debt all at records in 2026. The belief is the same. This time is different. Permanently high plateau in 1929. Housing never falls nationally in 2008. The Fed won't let markets crash in 2026. Every bubble shares this fatal belief. The cascade mechanics are the same. Forced liquidation triggering more liquidation, credit freezing, panic selling. These are mechanical processes, not emotional ones. The wealth transfer is the same. Those with cash, gold, short positions profit. Those fully invested, leveraged, and unprepared are destroyed. This pattern hasn't changed in a century. What's different? The scale. 1929 U.S. stock market capitalization, $80 billion. 2008, $12 trillion. 2026, $50 trillion. The scale is 4 times larger than 2008. The losses could be $30 trillion. The speed. 1929 took 3 years to bottom. 2008 took 6 months. 2026 could be faster. Algorithmic trading, global interconnection, instant information, everything moves faster. The crash could happen in weeks. The global interconnection. 1929 was primarily an American crash. 2008 was global, but emerging markets recovered quickly. 2026 will be truly global. China, Europe, emerging markets all interconnected. A crash in one region spreads instantly to all regions. There is no safe haven, the government's capacity to respond. In 1929, the government did nothing initially. In 2008, the government had tools, rates at 5%, fiscal space to spend trillions. In 2026, rates are already low. Government debt is already 120% of GDP. The Fed's balance sheet is already massive. There is less ammunition. The response will be larger but less effective. The social consequences. 1929 created political extremism and the rise of fascism. 2008 created Occupy Wall Street and deep political polarization. 2026 could create something far worse. Wealth inequality is already extreme. If the crash destroys what little wealth the middle class has left, the political consequences could be revolutionary. When crash destroy the middle class, political systems become inherently unstable. Let me show you the timeline. This is not a prediction of exact dates, but a pattern-based projection. Early 2025 now. Markets at all-time highs, valuations extreme, leverage at records. Investors believe the Fed will prevent crash. Mid-2025 to early 2026. The trigger event. A wave of bank failures, major corporate bankruptcy, geopolitical shock. Markets fall 10% to 15%. Phase 1. Initial shock. Spring 2026. False recovery. Markets stabilize or partially recover. Media declares the crisis over, investors buy the dip, but the underlying problems are spreading. Summer to fall 2026, the cascade begins. Defaults accelerate, credit freezes, markets enter freefall, fall 50% over 6 to 9 months. Late 2026 to mid-2027, panic bottom. Unemployment at 10%, banks failing. Government intervention begins, Fed cuts to zero, Congress passes stimulus. This is the moment of maximum fear, late 2027 to 2030, slow recovery. Markets stabilize, then rise, economy recovers slowly, unemployment falls, but stocks don't reach 2025 levels again until 2030 or later. This timeline could compress or extend by months, but the sequence is historically locked. The pattern says the crash happens late 2026 or 2027, and the pattern has been right twice before. What should you do with this information? This is not financial advice. I am not a financial advisor, but pattern recognition suggests several strategies based on what demonstrably worked in 1929 and 2008. 1. Reduce stock exposure. If you're 100% invested in stocks, reduce to 50% or 60%. Hold the rest in cash or treasury bills. You'll miss some gains if markets rise, but you'll preserve capital when they crash. 2. Hold gold. Allocate 5% to 10% of your portfolio to physical gold or gold ETFs. When the crash comes and the Fed prints money, gold will surge. 3. Identify quality companies. Make a short list. Apple, Microsoft, Berkshire Hathaway, Visa, Johnson & Johnson. Companies with strong balance sheets and low debt. When the crash happens, and these stocks fall 50%, buy them. 4. Prepare psychologically. The hardest part isn't the strategy. It's having the courage to buy when fear is maximum. In March 2009, buying stocks felt insane. That's when fortunes were made. Prepare mentally now so you can act then. 5. Protect your income. Make yourself invaluable at work. Reduce personal debt. Build a large emergency fund. If you lose your job during the crash, savings will keep you afloat. 6. Watch the indicators. Commercial real estate default rates, regional bank stocks, high-yield bond spreads. These will signal precisely when the cascade is starting. When these indicators deteriorate, it's time to get defensive. The 2026 crash isn't certain. It's possible the Fed engineers a soft landing, that valuations gradually normalize, that leverage unwinds slowly instead of explosively. But the pattern says otherwise. Twice before, when conditions aligned like they are now, devastating crash followed. Crash that destroyed the unprepared and enriched those who saw it coming. The setup is complete, the bubble is inflated. The leverage is extreme, the belief in permanence is universal. We're waiting for the trigger, and when it comes, the 5-phase pattern will play out. Initial shock, false recovery, cascade, panic bottom, slow recovery. Wealth will transfer from the middle class to those positioned correctly. Lives will be destroyed, fortunes will be made. And in 10 years, economists will write papers analyzing why no one saw it coming, even though the pattern was obvious. If this documentary showed you a pattern you'd never seen, if you now understand that crashes follow predictable sequences, if you recognize that 2025 looks exactly like 1928 and 2007, then you have a choice. Ignore the pattern and hope this time is different, or recognize the pattern and position accordingly. The pattern doesn't guarantee the crash, but the pattern has been right twice before. And the pattern says late 2026 or 2027 the crash comes. The Great Depression, the global financial crisis, and coming soon, the 2026 crash, 3 times. Same pattern, same sequence, same wealth transfer. The only question is whether you'll see it coming or learn the pattern the hard way. History is clear. Those who understand the pattern survive and profit. Those who ignore it lose everything. The setup is complete. The pattern is repeating. The crash is coming. What you do with this information will determine which side of the wealth transfer you end up on.